Ladies and gentlemen, welcome to the Capital Flows live stream. Hope everyone is having a good week so far. A lot of interesting things happening in the world with the Warsh interview, with everything in markets. You know, we're kind of at these highs now, and everyone is a little bit worried, and they're thinking, are we going to chop around a little bit before we melt up? Are we going to just keep bidding? And then how do all those kind of moving parts connect to the credit cycle and everything else? And, you know, one of the main ideas that I was covering in the live stream of the last couple of days and last week especially is that you want to be very intentional in how you're analyzing the mechanics of the underlying system. And so the entire goal that I've had this week is saying, let's break down each of those moving parts so that each of you guys not only have the playbook to analyze it, but also if you have experience in markets, then you know the exact signals that are beginning to take place across all of these sectors. And so that'll be the focus of today. And the specific focus will be on the real estate sector and mortgage rates and how that links to the credit cycle. And I really wanted to focus on that because, you know, when we take a step back and think about where the consumer balance sheet is, where the balance sheet for corporates are, and how that connects to the probability of defaults and delinquencies and everything like that, that could be a major factor that takes this entire credit cycle and throws it into the dumps. And a lot of people have talked about how we have the same mechanics as 2008. We have the same situation. It's just about to go off a cliff. And my entire goal in this breakdown and live stream today is to give you all of the data points that you would want to think about so that you can make an informed decision about what your view is. And if you are a real estate investor, hang on a second. If you are a real estate investor, if you are someone who is a homeowner, or you're thinking about becoming a homeowner, and you're saying, I really want to get an idea about how I should think about mortgage rates, how I should think about real estate overall in the cycle, this is going to be the perfect presentation for you. And as a reminder, we'll be going out over everything, and everything in this slideshow and this deck will be available at capitalflowsresearch.com after the live stream. So if you're not already a subscriber, go to capitalflowsresearch.com. I'm going to be doing these streams every morning at 8:30 a.m. Mountain Standard Time. And then also I'll be live streaming these on Substack now. So if you want to ask a question or come, talk to me a little bit more in the comments section about what you want me to cover during the live stream, put it in the chat section of Substack. That's always super helpful. And then if you guys are watching this on Twitter, I'd really appreciate it if you guys are able to reshare it and like and retweet it and everything. I always appreciate you guys. And, I have people reach out to me sometimes and say, I've appreciated all your work and everything that you're putting out. It is a ton of free content. Let me know if there's anything I can do to help. If you want to help, you can just retweet the stuff. That's always super helpful. I always appreciate it, and appreciate all of you guys showing up to all the different streams that we're doing. So on the real estate side, we're going to go through all of that today. And then after that, I'm also going to be sending out a real estate report that really breaks down those mechanics further, especially if you're trading individual equities or you're trying to understand which stocks to play with in the real estate sector overall. So I'm going to be covering that. And then James is here today. And I think the perspective he can provide is going to be really helpful as well, because we've talked about this entire dynamic of home ownership, of how you have this really big divergence between the, boomers who have all these homes at a low cost basis. Do you have a high mortgage or a low, mortgage payment relative to where we are at in the cycle and things like that? So I think that's going to be really helpful from a big picture perspective. So James, thanks for joining today. And really appreciate you just kind of hopping on. I think this topic, I feel like, hits home for everyone in a big way, and I think it'll be really good one to discuss.
Yeah, I think that's right. Real estate, man, it's something to do with the tied in feeling of the American dream, and it's really interesting timing, giving like a new Fed chair, interest rate, the oil shock, like it's all a really interesting cocktail. And I don't know if you've noticed this, but over the probably 3 or 4 times that Warsh has been put somewhere publicly, the markets haven't liked it, right? So I just think that's an interesting litmus, because just Trump likes people that are seen as good for markets, right? So I'm just keeping that in the back of my mind, see how markets react every time this guy talks. So I don't know what your thoughts on that are, but it's kind of interesting.
A lot of my view around Warsh right now is that he represents less of an explicit bull or bear case and more about a wild card. Because I think everyone realizes he's not going to do the same thing that has been taking place. And so I think about it less as it's explicitly bullish or bearish, and more about, well, Warsh is going to inject a lot more uncertainty in markets, kind of in the same way Trump is. I think he'll do it in a different, more, I don't want to say professional manner, but in a manner that's less, kind of in your face Trump style, and he'll do it in his own way. And I think his even comments about, well, he doesn't believe in forward guidance or some of these other things, that could really change how markets price these, rate curves, and how that impacts long end rates and inflation expectations and everything like that. So I think it's going to be very interesting. In terms of the real estate side, James, maybe, we're going to talk about the stock side, the stocks in the real estate sector, how it connects to the overall equity market. And then, we'll also go over how to think about the underlying construction that we see and how it connects to everything. But what has been your, as I go through this slide deck, what is kind of your thought process and view toward real estate, as you've kind of progressed through, your trading experience and all of kind of these years that you've had trading and then investing in real estate and things like that? What has kind of been your mindset toward that overall from a kind of a practitioner's perspective?
Yeah, real estate's like such a vague term, like it involves so many different things, or so many different options within it. And I've only bought a house. I bought my house 5 years ago, and I've only started investing in multifamily real estate, probably somewhat similar. And I don't have some sort of affinity for real estate like many others do, but I do use it as a way as a protective mechanism against myself. Sometimes I feel as if locking money up helps me protect me from launching a lot of capital at certain more aggressive things. So I'm willing to give up some of the potential, maybe growth upside of other maybe better plays or more volatile things for the, let's call it, safety and security that seems to come along with real estate, which is by no means guaranteed. And there's problems in and around the real estate sector as a whole. But that's kind of how I approach real estate. It's my defense to my offense. And but I don't, there's a lot of people who are very, very much into the weeds in real estate, and it's not my forte. So that's why I'm excited to talk a little bit more about it.
Yeah, absolutely. I think the place I wanted to start on the real estate side is that we have been in this period of time where real estate prices just simply go up and to the right. I mean, it's very much like the stock market. And my view has been that real estate is not going to have another 2008 financial crisis moment. And if you actually look and spend time in the underlying mechanisms and constraints in the consumer balance sheet and everything like that, you'll begin to realize that the, people who are kind of always throwing out this bearish narrative, they're not really actually going to the data. They're not going to things and saying, well, what would falsify my view? What would begin to do that? And, frankly, one of the factors that exists today that didn't exist back in 2008 is that, if you don't buy a house, just think about what would happen if you were, bearish in 2020 and 2021 and didn't buy a house because you felt like everything was going to collapse. Now, home prices are higher, mortgage payments are higher, and everything is kind of stacked against you even more. And, all the people that are kind of thrown out the bearish narrative about real estate, they'll never talk about that side of it because that doesn't really connect to their view as much. And, here is a chart of the 3 major home price indices that you can see here. And, we've been going up in a straight line. This period of time in 2020, 2021 was obviously one of the most aggressive periods of price appreciation because of low mortgage rates. And then we've had this period of consolidation right here in home prices. When I see something like this, what I want to do is say, what is the driver of these home prices? How does it connect to income, affordability, and specifically the supply and demand of houses? And that really brings us to this chart, which is a new buyer's mortgage payment, medium home price, and 30-year fixed rate with a 20% down payment. Simply put, if you are just kind of a regular guy in the mortgage market, you're going to put down 20%, you're going to get a regular mortgage rate at market. How much are you going to have to pay for a regular house or a 500K house roughly? And over, the period between 2010 and 2020, this entire period of time, you had a very low mortgage payment. And again, this is just for a median house price in the United States. And you had it at about $1,000. Now, when you had these shifts in the entire interest rate and inflation picture, the principal component and interest rate component began to rise significantly. And now you have a much higher interest rate component, which just means that when interest rates rise, it makes money more expensive and you have to pay more to have a mortgage. And that makes sense. Everyone kind of knows that their money doesn't go as far because they have to take a higher interest rate for what they're doing. And this begins to pull more and more people out of the market. And what it's supposed to do, in a sense, is begin to slow down demand. Interest rates are the primary mechanism that impacts the entire real estate market. And I would say that real estate specifically has the highest sensitivity to interest rates of any basically market in the world. Banks and banks managing their balance sheets, and then the real estate market are the 2 things that have the highest sensitivity to changes in interest rates, which is why it's things that I watch so closely. So when we begin to say, let's dig into how this really functioned and how this connected to the balance sheet of people and how it links to mortgage rates and then also mortgage applications that people have taken out. Here is a chart with 2 major data points, and these are going to be key to understand. In white, you have the Mortgage-Backed Association index, which just shows the purchase of mortgage applications. So simply put, when this white line is going up, people are taking out mortgage. When it goes down, people are taking out less mortgages. Now, that is typically inversely correlated to interest rates, and specifically 30-year mortgages. So you'll notice that as we move down right here, you had interest rates moving higher. So people began to take out less mortgages. But the key thing to realize is that everyone took out their mortgages in this period of time right here. There was a massive spike in volume and everyone locked in their house at these levels right here when interest rates were around this level. Now, what has begun to take place is that all of this positioning, you can almost think about this as just like equity market positioning. You have everyone that locked in a rate at a lower basis. And then as we moved into this period of time, post 2021 and 2022, what began to occur is all the inflation that pushed incomes up, but mortgage rates were still locked down at these lower levels. And you can see that the mortgage index went to its low down here, and there was basically no one taking out mortgages. As 30-year mortgage rates have dropped, you can see that we've ticked up just a little bit and people have taken out more mortgages. However, we're still at like a pretty significant cycle low right here. And I think that's one of the key things to recognize is that there is still pressure on the real estate market. However, the fact that there is so much pressure on the real estate market, higher rates, lower mortgage indexes, the fact that that's taking place and home prices are still at basically highs. You know, we've slowed a little bit, but we're still at highs. That's an indication about how resilient the market is. And you're going to say, well, why is the market so resilient? It's a combination of two things. Number one, all of the people that bought houses right here, they're not being forced to sell them. If the labor market began to unwind, then they would, and their income came offline, then they might be forced to sell them. However, because they've locked it in at such a low rate, they're going to do everything possible to not sell their house that they locked in at a low mortgage rate. Because, you know, everyone's house is their biggest expense in life, typically, especially for people that are on just a regular income. And so the idea here is that you have these forces that have begun to get set up in the system where all of the people that locked in those lower mortgage rates, they have a lot more resilience to economic shocks. And the fact that you have these shocks of higher mortgage rates indicates that there's still not enough people selling houses. There's still not enough people that are getting squeezed out of the houses they already have. So that's number one is, you know, this is just basic supply and demand. You need to have all the people that bought those houses sell, which is not happening right now. And it's unlikely to happen unless you have a major crack in the labor market, which doesn't seem likely right now. The other side that could begin to soften the market more is supply coming online. And, excuse me. And the way that supply can come online is through more houses getting built. I actually want to go over this chart right here, which is indicative of the lack of mortgage delinquencies that we are having right now. So people are saying, oh, well, mortgage delinquencies are going through the roof. People don't get it. There's already foreclosures happening. Hold the phone. We are literally not seeing any significant level of delinquencies in the housing market. Are some taking place? Yeah, sure. Are they broad-based? No. So you can always pull anecdotal evidence and extrapolate it to the whole. But when you look at the whole and you look at the moving parts on a broad basis, delinquencies for mortgages have not increased considerably. I mean, just think about it. We had, higher rates in 2022, 2023, and we only had delinquencies, peak up a little bit. Massive difference than 2008 right here. And so the other side that you would want to think about, so what could move housing prices down or make them more affordable, is the supply side and more houses getting added to the real estate market. And what I would want to talk about right here in this chart and the next one is noticing how in 2008, what we had is a pretty significant contraction in building permits, new homes that are started in blue, and then housing completion. So this is kind of the value chain, supply chain kind of, say value chain, not supply chain, value chain of the real estate market. You get a permit, you start building it, and you complete it. Those all moved in lockstep in 2008. You actually had building permits lead the way because that makes sense because you have to take out a building permit before you start a house. And so the building permits really led the way in 2008. Now, what you will notice is that since that period of time, we have just accelerated. We added a ton of supply to the market in 2020 and 2021. And well, we took out a lot of construction. A lot of that supply came online in 2023 and 2024. So we started building here. You can see building permits increasing a ton. And then you have a bunch of houses in blue get started, but then the completions in orange right here didn't spike until, a couple of years later. So basically, all the demand in 2021, 2020, all of that began to cause home builders to make a lot more homes. And all of those homes came on the market just in the last several years. It's come down more recently and we're consolidating a little bit more. But that's why right here, these home prices have slowed a little bit, but still they haven't been in outright contraction. And that's still indicative that even when we add supply to the system, we're not seeing delinquencies or downward revisions. You could have home builders come in and just dump a bunch of houses into the market and crash prices. And that begins to help people, or that begins to cause people to not be able to refinance, which, going back to this chart that I had that I didn't go over yet, here's the refinance index. And what you can see is, people have refinanced in this range right here. You can see the refinance ticked up a little bit. You can also see that everyone refinanced their house when rates collapsed right here. So refinancing ticked up a little bit when rates came down, which is actually indicative of either people up here or people here lowering their payment. And that means that their home prices have actually not fallen enough to make it, they're still incentivized to refinance if they bought at these highs when mortgage rates were at these levels. And it means that their home prices haven't dropped. No one refinances if their housing price is collapsing. And so when you think about where we are in the supply side, we have some more supply that has come online. But when we look at the overall structure of total existing home sales and the supply on the market, we are still in a structural low in many ways. We've ticked up and we're rising a little bit, which is why you could have some softening. But you'll notice that this move down or move up in supply. So this is just U.S. existing home sales, months of supply. And again, if you're watching this and you want this chart, all these charts will be available afterward at capitalflowsresearch.com. So just go there and you'll get all of this entire slide deck, all these charts, and then also the report that I'm sending out on the entire real estate sector and how to think about the sector flows and factor flows in real estate right now. So when we go to this side of things where you have mortgage rates, and let me kind of tick back a little bit, mortgage rates have dropped a little bit, which makes it a little bit easier for people to buy homes. So this is basically allowing demand to come online. As demand is coming online just on a marginal basis, you have supply coming up as well to meet that. So that's why the real estate market has stayed in balance and why the extreme views have really not come to fruition about everything collapsing, because people are going to say, oh, well, supply is coming online. It's about to shoot up and we're going to have a really big crash. And you say, hold the phone. Yes, supply is coming online, but mortgage rates have come down enough to not drag prices down. It's simple supply and demand. And so when we begin to shift and say, okay, well, now we need to understand mortgage rates. We want to understand how do mortgage rates connect to the larger macro picture, and how can I take an informed view on the mortgage rate side of things. And what I would say especially is if you are a real estate investor or you are trying to understand the changes in interest rates or the changes in housing affordability, interest rates are going to be the most important thing that you can understand. And, I'm still, surprised at how large of a market there is for, people who are not at an institutional level to be able to either hedge some of their interest rate risk or time some of their interest rate risk, or simply just be aware of the potential risks that are on the horizon and be aware of the macro environment. Because every single desk and every single large institution that is acquiring real estate, or they have a REIT or a very large real estate portfolio, they are always actively taking views on interest rates, hedging their interest rate risk, and they spend a lot of time just understanding interest rates on a macro basis. And so as more and more institutional players come into the market and have any type of, capital deployment, which is just going to increase because the institutional side is just taking more and more of the float, then the idea is that you need to be aware of what is going to move these institutions and what they are doing, because they're going to move more and more of the real estate market. And so when you look at this chart right here, what we have is the 30-year fixed rate mortgage in white right here, and then the 30-year US Treasury, which is just the same type of, it's the credit risk free rate. It represents only duration risk, right? And so the move and spread between these two rates matters for everything, because if someone's going to take out a 30-year mortgage, the mortgage broker or bank that's going to give that to you is going to say, okay, well, what's the 30-year mortgage rate at? And then I am going to give you a rate above that. So you'll notice that the mortgage rate right now is at 6.39%. The 30-year Treasury is at 4.88%. And you can see that we have a spread between them. That spread is what determines the amount of credit risk or credit risk premium or risk premium that you are paying to have a mortgage rate. Because if you or I take out a mortgage, we are more of a credit risk than the US government. And that is reflected in the spread between these two data points right here. So the idea for this chart is you want to be watching two things. Number one is where are interest rates going on a directional basis? And then number two is what is the spread between them? The reason why is because when the spread increases, that's an indication about credit risk, and it also connects to demand. So notice here in COVID, you had credit risk blow out, and you had obviously because you had all the stress in the credit market, but you had mortgage rates, they popped up a little bit and then they kind of trended back down. And then you had the US Treasury rates move down pretty significantly as well. But notice the spread that took place after this. You basically had credit risk collapse, and it was incredibly cheap on a credit risk basis relative to US Treasuries to buy houses during this time and take out mortgages during this time. Then you will notice that when you had this move up in 2022, it was not just that interest rates moved up on an outright basis, but also the spread increased as well. So notice right here, when interest rates were moving up, US Treasuries were moving up, mortgage rates were moving up as well, but the spread between mortgage rates and US Treasuries was also increasing. That begins to put a lot more pressure on the real estate market. And what you will notice is that as we, kind of came out of this period of time, one of the reasons why you have had a bit more support in the real estate market is that even though, rates have been at these higher levels right here, the spread between mortgage rates and US Treasuries has been dropping. If that spread drops, that is also stimulative to the real estate market. And I'll even, kind of dig into this a little bit more with where are mortgage rates relative to inflation swaps and inflation expectations. So the system overall, when you take out a mortgage rate, you get to lock that in at a specific interest rate. So for example, if you locked in your rate in 2021, you were able to lock in a rate, sub 4%. Then what began to happen is inflation went to almost 6%. So what you had is a liability or a debt service payment locked in at a low rate while inflation in the economy rose. And this is really key because, when people talk about, well, you have a fixed payment, but inflation changes and things like that, we want to quantify that and say, okay, well, how is that functioning during that time? Am I making or losing money on a real purchasing power basis? And so we want to compare 30-year mortgage rates to inflation expectations. And we want to do that with short-term and long-term inflation expectations. So for example, right here during this time, we had inflation expectations move above 30-year rates, 30-year mortgage rates. Then as we had this shift, so in real terms, basically taking out, when this spread was negative, taking out debt actually paid you money on a real purchasing power basis. After that happened, we had this spike where mortgage rates were then pushed above inflation expectations. And since that time, we have had a pretty wide spread between the mortgage rates and inflation expectations, which means that you're paying a lot more in real terms above inflation to be able to have a house. That's why not only on a nominal basis are things more expensive, but also on a real purchasing power basis, things are expensive. And when we go to something like 30-year rates and we look at the mortgage rates on the 30-year relative to the 30-year inflation swaps, we see something very interesting because the spread here is very similar, but you'll notice that inflation expectations on the long end have remained pretty well contained, but we are beginning to see mortgage rates fall relative to that. And we're seeing that on the short end as well, right here. This is why when I talk about real interest rates and how when real interest rates fall, that reverberates across the risk curve. It also reverberates through the economy, because if you're in real terms, it becomes more attractive to take out a mortgage, that will, not even subconsciously, but in tangible terms, if someone makes more money in nominal terms, if someone makes more money and then mortgage payments don't move, they're going to feel like they're going to be able to afford a house. So it's very possible. I'm going to go back to this original chart that I was at. Let's say that these, payments don't change. We still have this same level of affordability in the real estate market. If that doesn't change, but incomes rise, and let's say you make $4,000 a month, and then after a year you're now making $6,000 or $7,000 a month. Well, this mortgage rate, even though it hasn't changed during that time, can feel a lot cheaper and can push you to allow you to buy a house. That's what this chart shows. It shows you the amount of inflation in the system relative to the mortgage payment that you would pay. And so this is going to be one of the key things for this entire idea of the credit cycle that I've been laying out. If you have been on the streams for everything that I've been talking about over the last several weeks, one of the main ideas that I've been talking about is that as these crude prices have risen, that has pushed more money into the system. But on a real purchasing power basis, we've actually added a bit of money to the system. This is a very tangible example of that because it will represent how individuals in the economy, if they begin to make more money or you have inflation run through the system a little bit more and not intrinsic demand destruction or something like that, which we're not really seeing. If you have that, then that can begin to increase people's incomes a little bit when it flows through the system. And if mortgage rates don't keep up with that, then in maybe 3 or 4 months, people are going to say, I kind of have some more money and I'm actually able to, buy a house just on a marginal basis. And again, these are all things happening on the margin. And so when we think about the long-term kind of changes, what we want to do is connect those changes to the actual tangible price action in markets. And here's where people begin to make mistakes, because you always want to connect these different changes in nominal and real interest rates with the real estate sector, the real estate ETF, the XLRE of the S&P 500, and then also the ITB Home Builders ETF right here. I'm going to walk you through both these charts and kind of explain where we're at in terms of real interest rates and also the real estate sector. But maybe before we jump into that, James, any kind of initial thoughts or things that you would think about digging into a little bit more? Any thoughts on kind of what we covered so far?
I don't think so. I'm trying to still wrap my head around it, but it makes sense to me that uh, the premium is starting to basically the premium people are deciding to pay is starting to kind of come over, and it doesn't like on that previous chart that you had with the if you could go back maybe that one, like it doesn't when I look at that bottom spread, it doesn't look like we're that far off of like relatively normal premium. Is
Yep.
that accurate? Like, kinda
Yeah.
like looking back at an average line there, which is actually surprising to me given so, like but with the ability to refinance and stuff, that it makes it, like, interesting to me for the mentality of buyers because like, if they see that and they're like, "Well, okay, there's a premium, like a significant premium right now, but, like, it's likely to come down over time." Do they still may purchase it now, right? If they could continually refinance along the way or like how do you think about that? Because the normal consumer is not necessarily thinking too much about like inflation expectations going out. So I don't know how to think about that part of it
Yeah.
really.
So I think that's a great question. What I would say about that is the normal person is not thinking about any of this stuff, right? They're
Yeah.
just kind of like, well, I just see these kind of moving parts, and maybe eventually I'll see an opportunity where I feel like it's a good time to buy. And that applies to refinancing and selling or whatever that might be. What I would say on the refinancing side is that there are several different key things that go into refinancing. Number one is, is my home price higher or lower than when I first bought it, and our mortgage rates higher or lower than when I first bought it. So they're not going to know what is taking place all the time in a macro sense. All they're going to look at is my home price, going back to this chart, is my home price higher than when I bought it? If the answer is yes, then they're going to say, okay, our mortgage rates lower than when I originally bought it? And if the answer is yes to that as well, then the entire question is, okay, well, what's the spread? Right? And that's what a mortgage broker would, kind of always talk with you about, to say, okay, well, is housing prices a little bit higher? Yes. Our mortgage rates a little bit lower? Yes. But it's going to cost you some transaction fees on the refi, and you're only going to save $100 a month. So it's really not, let's wait for a better opportunity when that spread widens a little bit more, or, moves a little bit more, so that it can be more advantageous for you. You can save maybe $500 a month or $1,000 a month, right? And so all of these things are happening on an incremental basis, and especially with how aggressive the real estate market is. If you have a mortgage broker saying, "Hey, do you want to save $1,000 a month if you refi?" You have the perfect situation for it, and you just say, "Okay, yeah, what do I need to do?" And they just run you through it, and you're saying, "Okay, so I'm, basically going to pay some fees and not lose any money, and I'm just going to lose less money every single month." Yeah, basically, and you're like, "All right, sure, I'll do that." But that, they're not constantly looking at, the market timing of every single thing. They're just seeing the risk reward and feeling the scenario in the same way that someone with an income and someone who is trying to buy a home is looking at the same thing. Is the home, is my income increasing or decreasing? Can I afford, this price? And how does the price impact, the price of the mortgage rate, right? So there's very simple binary inputs of, is the home prices higher or lower, or mortgage rates higher or lower? And then from there, it's all about, well, what's the spread where it would be advantageous for me? And that's going to be different for every person, which is kind of the beauty of the entire economy, where some people are going to be more risk averse, some people are going to be more risk taking, and then some people are going to have higher or lower incomes. Sometimes they fluctuate, but everyone is incrementally always going to make these little decisions as they get, sold on it, to either refi, buy a new house, sell a house, wait, whatever that might be, until all of these incremental things take place, until people are forced to buy or forced to sell. And, in my view, 2021 was really the period where people were forced to buy. That's why the refinance index went up so much during this time. And you had people that really, were so aggressive in buying. And for anyone who actually knows how the cycle works, they know that sometimes you're just forced to buy. Sometimes you're just forced to buy equities because you can't, take the devaluation of your dollars, which is why melt-ups occur. And then the same thing happens on the downside where you're forced to sell. The problem is we have not unwound positioning enough to force people to sell. We're not having delinquencies tick up that would indicate people being forced to sell, and we don't have enough supply getting dumped on the market that would begin to force people to sell. You can think about, for whatever neighborhood that you're in, if you start getting a massive amount of homes built there, and then you start looking on Zillow and wherever else you're doing to appraise your house and saying, well, because they're adding so many homes, now my home price, the home price that I have is lower, and it keeps dropping. And then I start seeing people sell houses. You'll be fine as long as you don't sell your house or refi, right? Because you would have to refi at a lower home price, basis. But some other people, if they end up losing their job because people are getting laid off and you start having a recession, then they might have to be forced to sell their house at the capitulatory moment when it's the worst time to sell it, right? And so what I think about for these types of moves is the entire shift that took place post 2020 is that you now have additional forces in the market that are causing real purchasing powers to change. So let me go to this chart again. In the past, in kind of this entire period of time, you had mortgage rates kind of sit in this range, and then inflation swaps would drop and then come back up, drop and come back up, drop and kind of come back up. Now we are at this higher basis of mortgage rates at this higher level. I think mortgage rates will probably come down over the next year, but we're at this higher level. And now it's kind of flipped where you have this higher mortgage rate that makes it less affordable, but that's not going to cause boomers to sell their houses. So this is kind of a new reality. The thing that is going to determine these supply and demand imbalances and forces are still the inflation swaps and inflation in the system that move up and down right here, but it's going to be on the real purchasing power basis. So in the past, it was all about where am I at nominally? How is that going to impact my ability to buy or sell a house? Now it's all about this real purchasing power devaluation or revaluation. And I think one of the reasons why it's so difficult to understand it intuitively is because all of us think in nominal purchasing power terms. We think like, when you think about buying something, you think about like, is this $20 or $30? You don't think about, oh, wow, I'm losing money in real terms, right? So that's one of the reasons why it's difficult to intuitively conceptualize this, because it's fundamentally about something that's unseen, a real purchasing power change that erodes kind of your capital. And that's why the interest rate complex and understanding interest rates is so critical, because it quantifies that unseen element.
Yeah, it's just like interesting anecdotal stuff from my end, like how people talk about it compared to thinking about it this way. And it's like a lot of market things, like a time-based capitulation, right? Like something I've seen around here is people for years were like, I would never buy a house right now, right?
Yeah.
But for whatever reason, you fast forward 2 years, like the Overton window shifted. Everything's just like known to be more expensive now, and they just kind of accept that, and then they're like, you know what, we're just gonna buy now. And I find that pretty interesting because like the wealth effect or whatever is still strong, right? Like they still see their stocks going up. They're feeling probably better off. So they finally like capitulate and buy. But on the sell side, it's like no chance, right? And I am in an interesting area, I guess, like where properties are a little bit more scarce and there's not as much building going on and stuff. But I find it fascinating to see like people are just like, screw it. Like they just get fed up with not being able to like be an owner of a home. So yeah, kind of interesting stuff.
Yeah, I think here is the reason why there is so much edge in the real estate market on a kind of a fundamental basis, and why the industry is so large. I think a lot of people think like, oh, well, I don't know if we need as many real estate agents as we have right now, but overall, with how many industries we have with syndication and development and construction and rebuilds and things like that, there are so many inefficiencies in the real estate market because they're all local markets. Now, they've consolidated a little bit as more institutional capital has come in and deployed more money. But, you can think about the simple fact that, if someone works remotely and they say, well, I can afford this house here and then this house over here, so I'm going to go over here. It's functionally like getting if you go to another state where real estate is cheaper and you have a mortgage payment that's half the payment that you would get in California or some other state with higher prices, then you are functionally increasing your income by 50%. Yeah. Right? If you go to your boss, say, can I have a 50% pay increase? And he goes, no, it's not going to happen or whatever. Right? And then you try to grow a business and that's more difficult. Then you can just say, okay, well, where's an inefficiency I can take place or I can take advantage of? Oh, let me move over here. Same lifestyle, same vibe, same kind of thing. It's still suburbia because the majority of people, unless you're in a major city, you live in suburbia. So that's also been a major factor that has, just think about if a large percentage of the population get a 50% increase, and again, I know this is a little extreme, but a 50% increase in their income, what happens to the system? That's why all the migration trends were so interesting, because you're functionally increasing people's income as they move geographically, which is another interesting thing, because all of these real estate changes are all so local. They're also connected there, but then you also have these larger macro forces that are impacting things on a national basis, and obviously the institutional capital that's getting integrated as well.
All right. Yep. Keep going.
All right. So let me pull up this other chart here. Okay. Yes. So the chart that really encapsulates this entire progression as it relates to real estate and then also real interest rates and this real purchasing power change is the XLRE ETF and the Home Builders ETF, the ITB ETF. What you will notice is that as you had real interest rates drop right here, this is 2-year real interest rates, you had the commercial real estate sector really pop off during all of 2020 and 2021. And the reason for that is that people syndicated so much real estate and REITs were able to lock in rates at such a low level. And they were able to, basically roll over all of this debt and lock it in. The problem with that is commercial real estate typically has debt terms that are shorter in their nature. And then you also had commercial real estate didn't benefit during COVID as much as things like, residential home prices, because you had the entire work from home thing. A lot of people kind of shifted and a lot more people are staying home. So you had, the office building kind of dynamic where no one's going to the office anymore. So what has taken place is that all of these REITs basically levered up and locked in lower rates. And then, especially in 2020, a ton of them, and especially in 2021. And then what happened is, as you have commercial real estate properties kind of prices just kind of top out right here, and commercial properties prices actually kind of had less upward momentum than residential ones. And then you had interest rates rise. Then what you had is the commercial real estate market shop in a range for a while. And this entire period of time of 2022, 2023, 2024 is functionally the market pricing in all of the short-term debt that these companies had to roll over, these REITs had to roll over. So if a REIT had a 5-year debt term that they locked in at 2020, then the market is going to reprice one based on just real interest rates. But then some of these companies had to roll over their debt at higher rates, which is why on net, the XLRE ETF isn't at new highs right now. right? There's a reason why, because all these companies had to roll over their debt basically in 2024 and 2025, and that has caused a bit more headwinds, but it hasn't caused significant delinquencies. It just lowered the amount of money that they had. So just imagine if you had a mortgage for your house that was a 5-year mortgage. You were basically, and you locked it in. Imagine, oh man, this would suck. If you got a 5-year mortgage in 2020 or 2021 right here, and you basically know in 5 years I'm screwed. Right? Like that's basically the entire commercial real estate industry that got shorter debt terms. And so now that's why we're not below, or that's not why we're not above all-time highs. But you will notice that as you have real interest rates fall, that has begun to set a bottom here in the commercial real estate sector. And, my view is that we're probably going to move higher. You don't have real estate rallying and holding these levels like this when, real rates are falling because, when there's a recession happening. Real estate overall is fairly resilient, especially on the home builder side. It's actually made a new high. So you can notice that in 2023, home builders made a new all-time high, even as real interest rates were higher. And you say, well, why is that? Why did home builders make a new high? And the reason why is when you lock in the 30-year mortgages, people aren't going to sell, right? It's not the same balance sheet dynamic as the commercial sector. So that's why the balance sheet differentials have allowed the home builders to still be able to sell more homes into the market because, boomers aren't forced to sell the homes that they locked in at lower rates. And on top of that, and again, 2023, 2024, 2025, the fact that we had one of the largest rallies during this time when interest rates were this elevated just tells you, again, how much resilience is in the system. And so, we came down a little bit and we've consolidated at these levels right here. But my view is that as real interest rates come down a bit more and I think mortgage rates are going to come down over the next 2 years, just marginally, not a ton, but marginally. As that has happened, you have had, a pretty clear floor here in home builders. And we don't have an imminent catalyst that would indicate home builders are going to go off a cliff. And so my view is that as real interest rates drop, you are going to have more support for home builders and you're going to have another push higher. Especially, with this kind of inflationary shock, yes, is that weighing on consumers a little bit for now? Yes. But once it makes its way through the system and rates are on net lower and especially if this goes back to this entire thesis that I've been laying out on the live streams, which again, guys, if you're not on the live streams every day, or if you're not you're going through all the summaries of the live streams at Capital Flows Research, you need to go through all of those because you'll get the context for what's taking place. When you have the potential for real interest rates to turn negative, that could be the biggest game changer for the entire real estate industry. So right now, 2-year real rates are at 78 bips. Notice that right here at, we're only 78 bips away from turning negative. If we turned negative in real interest rates, similar to what happened during this period of time right here, if that occurred in the next 12 months, which I actually think is possible, if that occurred, you are going to have so much capital flow into the real estate sector and into home builders and into commercial real estate and REITs because people are going to realize that on a real purchasing power basis, they're going to get paid to take out debt again. And so you can have, again, similar to this period of time, you can have real interest rates turn negative. And, this chart is probably not the best comparison because we have 30-year rates versus 1-year rates. But if we have that happen again, then you are going to have people get paid to take out debt functionally on a real purchasing power basis. And so the overall environment that we're in is that real estate overall, I think, is going to remain resilient. Mortgage rates and the real purchasing power of mortgage rates is going to be the most critical thing to watch. And then I want to shift to this visual here. for my dashboard. And I want to point out, this is going to be the topic of the report that I send out today. So if you want to understand the underlying names in the real estate sector in the XLRE ETF, you're going to want to read this report. The main thing that I will kind of draw your attention to is that this shows a breakdown of all of the return attributions for each stock. When you have more purple, it shows that there's more of a fundamental driver, which just means that the stock itself, the company itself, the real estate company itself, is changing so much in its underlying fundamentals that it's giving returns that are above or below the market, or they're extreme. They're the main driver. And so when you look through all of these different stocks, the one with the most fundamental attribution, so right here in purple, this has the most purple and most fundamental driver of all stocks in the real estate sector overall. If we click on that and you say, okay, well, what is this stock exactly? And you can see the price that's been moving up right here. It's primarily been, fundamental and sector returns. When you look at it and it's just been rallying this entire time and melting up, what stock is this? Oh, it's EQIX, which is the largest data center REIT that is building out on this entire AI investment theme. So you have certain companies that are really beginning to diverge from the entire sector based on the AI theme. And then you have other companies, for example, let me pull up, where is it? CoStar, which is the opposite. It's been moving down and having a fundamental attribution to the downside because it's getting absolutely cooked with all of the new AI disruption. And so you're having certain stocks, if you haven't used CoStar, they're basically a data platform. They do a lot of other stuff as well, but they provide, software to these kind of larger institutions. And if you think about what their function in the market overall is, it's basically an online marketplace that provides information, services, analytics. It's a subscription base. If you're in real estate overall and you're trying to buy and sell commercial properties, you basically use CoStar. So I used to use CoStar data all the time for some other projects that I was working on. And it has, some of the best data out there for the entire real estate market. Now just think about it. It's kind of a software company and it's getting disrupted in its fundamental attributes. And so you have things like EQIX. You can think about, long EQIX. That is, in each sector, you have companies benefiting and companies getting disrupted by the entire AI theme. And then on top of that, add real interest rates, how that impacts real estate, how it impacts flows. And that adds an entire additional dynamic to everything. And so the report that I'm going to be laying out on the Substack later today breaks down how all of these stocks in the real estate sector specifically connect to the fundamental flows being a disruptor or disrupted by AI and how it connects to the broader real estate market. And so that's going to be, I believe one of the most important reports I'll write this week, just because it's so fundamental to how you want to think about these changes in real estate as they connect to AI. I mean, it just goes to show that AI is really connected to and changing every single aspect of the market, not just software. And so, again, if you want to get that report, it'll be at capitalflowsresearch.com. If you want this entire slide deck that I laid out today, it'll also be on capitalflowsresearch.com. I just put out a paid report for subscribers last night, and I covered some important positioning things that I'll, save for paid subscribers. And then I'll also be sending out another report and breaking down a lot of the structural macro things that you want to be thinking about that I haven't really shared publicly for paid subscribers today as well. So, if you're not already, go be a paid subscriber on the Substack. I'll still be doing these live streams every single day at 8:30 a.m. Mountain Standard Time. I want to pull together a couple of these moving parts. And, James, what would kind of be some takeaways that you have that you're thinking about as we I know these are a little bit more complex issues, but anything that you would want to have more clarity on or refine, or what, what are you thinking about this kind of entire breakdown so far?
I think it's great. It made me think about it in a different way with regards to like the premium that you're spending. I think you mentioned that yesterday, but that helped. And I really like the potential confluence of sectors here. You know, like if you like Equinix or whatever is a good example of like you already had this broader narrative that exists, but now if a lagging sector could start to catch up but double down on that already existing narrative that's doing well, that creates like an amplification towards a really good bet, right? And that's, I mean, ultimately that's what you're looking to do, right? Is to find as much confluence as possible and rip it as hard as you can. And I don't know, those ones seem really interesting to me moving forward, especially because you just don't hear these things being talked about that much in general. And that's exactly what you're looking for, right? That's exactly what you want to see, is start to think about where the puck is going. And yeah, so I like it a lot. I have to keep tabs on it. It's just like these are companies and sectors that I've never really personally paid attention to, but I hang my hat on being able to take my risk reward framework anywhere to be able to execute. So I'm excited to see where this kind of ends up rolling.
Yeah, I think the cool thing, and again, we'll just dig deeper and deeper in all these live streams, is that I know that there's all of the guys that might do this type of analysis or even close to it on a private institutional side or at any of the largest, firms or something like that. They can't share it publicly. And also on top of that, they're not going to share their actual market view because their entire goal is to construct presentations and breakdowns around gathering more assets. They're not incentivized to tell you, hey, there could be some risks here, or hey, everyone made this mistake here, because they don't want to start calling people out in the industry. And you basically have this massive gap because most, just regular real estate agents, they don't have access to all of these models and the data and a breakdown of how everything is functioning. And so my entire goal is, I have models running and I quantify every single part of the real estate industry, especially on a macro basis. And then I'm actually building a lot more local models now. That's really interesting. And, again, people are so locally based, which is amazing because real estate is so much about local relationships. If you just take a little bit and overlap that edge with kind of a macro awareness, it is so valuable. So valuable. And so I would just challenge and encourage everyone, figure out where, if you are, in the real estate sector somewhere, if you are, simply involved in your local community, if you're involved somewhere on a macro basis, think about how you can integrate these types of framework and edges in what you are doing, just so that you can keep other people informed, right? Like, people are going to be able to work with people who have an informed view about the world because they know that you're able to analyze the risks clearly. And having a knowledge of interest rates and real estate are two of the largest factors in the United States. And so, this is going to be a topic that, I continue to cover on the live streams. I'm going to continue doing a live stream every single day, breaking everything down. And my entire goal is on the live streams, not just, Google stuff on Wikipedia or scroll Twitter or cover the news, is to really dig down into all of this. And then at the end say, okay, now you can have this entire slide deck, all the research, every single thing that I, kind of spent all day and, weeks and weeks building models on and all day putting together. And you get all of that work on the Substack. And that's kind of the entire goal of everything that we're doing here. So I would encourage everyone, I'll continue to put all the research out there at capitalflowsresearch.com. James is continuing to put out all of the videos that he's doing. And I would actually say, especially if you are an individual who is trying to think about buying a house or think about what are my life expenses, James has some great videos on, where exactly do you want to think about these different life expenses, life creep, risk, appetite, and things like that as it relates to, managing those types of expenses and things like that from a mental, aspect in life. Maybe you want to expand on that a little bit, James, and how you think about that before we kind of hop off.
It's mainly just the stuff I talk about of trading archetypes, right? We all have trading archetypes, right? We're all different. We all see risk reward different. Like all of our life situations, me and you are very different, right? Like I have a family. You seem to grind 23 and a half hours a day. Your risk tolerance is much higher than mine. So there's going to be sectors and bets and styles and profit goals and stop losses that are all going to be differentiated. And for the newer people, they haven't really figured out, like they might want to be like you, but their life situation is completely opposite. And that would actually hurt them to try and emulate exactly what you're doing. So especially like when it comes to real estate and whatever, like some people think it like they're young and they think they want to own a house or an Airbnb. And it's like, maybe that's like absolutely the worst thing you could do right now is to lock up your money in a capital intensive, time intensive situation that could go very south moving forward here. So, like we talked about, there's all these different sectors within real estate, and there's ways to amplify those bets in different ways. So you got to try to align it with your situation and what best suits you. But if you keep showing up for these live streams, keep talking about these things, you're going to be first at kind of understanding the ideas behind where we're heading, where you're heading, and then you're going to be able to have time to think about, okay, how do I express that in my own personal way the best? And I think that's ultimately the goal here, is to provide that value. And everybody can have outperformance, even if it's in slightly different ways.
Yeah, I think this goes back to figure out how to take a bet on yourself that no one else can take, so that you're the differentiating factor for your success. Right. And
I like it.
I think that just connects so well with everything that you're doing, because I think that there are just so many opportunities to take the experience and the mindset you have and the situation you have with family, or the absence thereof, or whatever it might be, just to take advantage and lean into whatever that is, right? And not try to be someone that you're not, right? And I think that my entire goal, I hope that a lot of the research I put out and content I put out, and especially these live streams, they're meant to provide kind of a breakdown of everything, so that people can take it and say, like, okay, how do I take extreme agency in what I'm doing right now, and how does this integrate into my process? And I think that's why I always provide all the educational primers and slide decks and the research, so that people can take it and apply it in the exact way that they need, right? Instead of kind of this entire, we'll just, follow this bot and don't do anything else, right? So
yeah, and just one last thing. I actually ironically put out a quick, simple video today. It should be live now on my YouTube channel, which is just my name, about how I think it is very important that you become a trader, and that moving forward here, that is a skill set that you're going to want to have in your arsenal. You need to kind of go with that global flows idea of betting on yourself for your future here, because opportunities are going to be around. You have a specific way that you can kind of go after those. And I think it's just going to be important to think about learning this skill set, learning how to move through the world towards risk rather than away from it, towards volatility rather than volatility suppression, towards accountability, away from everybody will do it for me. And that's kind of what the video is about today. It's nothing tactical. It's a bit more of like a, hey, this is very important. You're going to need to learn how to take bets, and you need to learn why you're going to be different and how you're going to impact the outcome for yourself. So check that out. Let me know what you think.
I like it. I like it. As a, let me see. Yeah, as a reminder, this is the channel that James runs. I watch all of his videos. I would encourage you guys to just go through all the videos that he's, putting out right now. And I would strongly encourage everyone to subscribe to all of his work and watch everything, because I just think it's game changer content in a world of AI slop. So those are the main ideas for today. James, thanks for hopping on and chatting. Everyone else, thank you for joining the Capital Flows live stream. I will catch you guys tomorrow at 8:30 a.m. Mountain Standard Time, and then I will be sending out that real estate report momentarily on the Substack at capitalflowsresearch.com. And with that, I will catch you guys tomorrow.